Good morning. Welcome to IG's early morning call. It's Thursday, 16th of March. The markets continue to be very sensitive to movements within the banking sector. Let's take a look at the headlines as we wait the start of today's European session, which at the moment at least is looking as though we could well see small gains after Credit Suisse late last night was given an emergency lifeline by the Swiss National Bank, the central bank in Switzerland, allowing it a blank check to sustain its operations immediately. But the big question is this enough to avoid a full-blown banking crisis? All this comes as the European Central Bank could well be the area of interest today to watch on the foreign exchange markets. It's deciding on interest rates. The expectation is it's still going to go full throttle into a 50 basis point rise across the board. But the big question is, will the governing body, led by Christine Lagarde, play safe and go for something less large? And the flight to safety continues. The dollar up yesterday, the yen, gold very much in demand this morning. We'll take a look at where the markets are expected to see some gains as we see this continued concern play out in the banking sector. So let's take a look at what's happening in volatility. Yesterday, we saw a spike which took us to levels not seen since the 26th of October last year. Now, this indicates that people are prepared to start to pull money out of risk assets, and the banking sector is in amongst this. Now, the banking sector is subject at the moment to all sorts of rumours and news and all sorts of areas of concern. But the worry is that despite the fact that since the great financial crisis 10, 12 years ago, when we've seen governments insist that banks continue to stoke up their cash reserves, big questions about just how much resilience they do have in a full-blown crisis. Now, this has seen money coming out of equities. I want to show you the 30-minute chart on the FTSE 100 before we go into the daily chart to show you the longer-term picture. You can see that the Swiss National Bank, which came out late last night in support of Credit Suisse, saw the 24-hour markets rise in the back end of yesterday's session. But since the last couple of hours or so, we've seen money coming out again. So despite the fact we are expecting a rise at the start of today's trade, we're wondering whether perhaps maybe we could end up seeing this line of support here, which were the lows we had back in December last year at 72.96 broken for the FTSE 100. As of the low point yesterday, we were 9.14% down from the highs that we saw, taking us up to those record highs back on the 16th of February at 44 points above the 8,000 level. German DAX, same sort of play that we've got here going on. It's not quite as large in terms of the percentage move that we've got here in the London markets, currently trading at 14,927. Same sort of thing. We're off the highs today on the 24-hour markets, but we are still penciling in a small gain at the start of today's trade. Just to run through the French markets as well, relatively strong pullback we've seen there from the record highs we saw back on the 3rd of March at 74.02. But again, money going into the markets after yesterday's big declines. You can see the 24-hour markets, the way in which the markets have bounced off here, the 100 period moving average at 68.63. Let's take a look at what's been happening overnight in the Asia Pacific markets. Got markets down across the board. Hang Seng stock index down 2% on the session in today's trade. I want to focus on what's happening on Wall Street as well, because it's worth getting onto the 24-hour markets as quickly as we can, because I think that's really where all this is playing out. The Dow Industrials yesterday down almost 0.9%. Same sort of percentage move on the broader S&P 500. The tech NASDAQ, now this is interesting in as much as it did eke out a gain. We saw late last night Adobe coming through with numbers that pushed that stock up over 4% post-market. But that NASDAQ closing before the Adobe numbers coming through. What I want to do is to show you the 24-hour markets on the Dow. Look at this. This is fascinating in terms of the market moves that we've seen. Bear market, bull market, correction. As of yesterday, the low point yesterday, we were down over 10%. Now, this technically takes us into correction for the Dow. So in the last year, since this move started with those record highs we saw back in January 2022, bear market throughout much of last year's session. Then came this, what I think, as we were talking about at the time, which was a bear market rally. It was a very strong one. It took us up into bull market again. But I'm now concerned about the fact that these markets are showing great amount of weakness. We're below the 200-day moving average. We've got the MACD pushing lower. We've got all the indications potentially suggesting that we are going to see further weakness in these markets. We've seen the Dow pull back down below these lows that we had here at 32,500. And the market's looking as though, for me at least, there's not much here now catching this market all the way down to a total retracement on the way down to the 13th of October lows that we saw established back there, which now, for me, is the price target. 28,629, 31,887. Now, on the IG platform, you can obviously, the whole point is that you can go short on these markets. And that would seem to be the direction of travel. You can see on the 24-hour markets, we've got a red candle here today, but we were very much off the lows in yesterday's session for the Dow. In fact, let me show you what happened on a 1-hour chart, because you can see pretty much where the markets have moved. I want to show you, this is Wednesday, the beginning of yesterday's session on the way down. Then came the recovery. That candle there is the candle which represented the market moves in the wake of the news from the Swiss National Bank that they were preparing to support Credit Suisse. Then came this rebound, which was after the close of the European markets last night. But look at this. The highs we saw here have not hit the highs that we saw earlier in the week. That was Tuesday, 4 o'clock in the afternoon. And these lower highs, lower lows, indicating to me that these markets are continuing to be on the way down. And that, I think, is the message to reinforce here, going back to the daily chart. This is why I'm seriously concerned about the fact that these markets will find new lower lows. And as I said, because there's not much more supporting, I'm now on with a price target down at the 28,600 level. Now, that's the Dow Industrials, which has gone into correction. As of a few days ago, the low point we saw here on the S&P down 9.25%. This is because the techs haven't lost as much as other areas of the market. Oil stocks down heavily. I'll show you oil in just a few moments' time. Oil's down because of concerns about the outlook for recession. Recession is being brought about by higher interest rates. Higher interest rates have to happen because of rise in inflation. So you can see that we've got this big sort of wind, if you like, that is prevailing around the markets at the moment, and it's howling around the markets, causing all sorts of stresses and strains. Now, the Nasdaq, as we've just seen on the daily chart, on the close of yesterday's cash session with small gains, that was the candle shape. Look at the way in which you saw this massive recovery in some of these Nasdaq stocks. Now, part of this, I guess, is possibly due to the fact that the Fed is now considering not doing anything next week at the Federal Reserve interest rate decision on interest rates. So there's a whole heap of interesting bits of information you have to digest when looking at what's happening with these markets. Let's look at what's been happening in terms of some of the individual stocks. I think Credit Suisse is the stock at the moment to watch out for. Swiss National Bank said yesterday it would provide this liquidity backstop. We learned overnight that Credit Suisse will borrow up to 50 billion Swiss francs. The Swiss lender's shares falling by as much as 30% yesterday. Big, strong candle on the way down. We were off the lows at the close of yesterday's session. Now, this is sparking a broader sell-off in the European banking sector. Let me just show you what's happening in the FTSE 350 banking sector. This closed out yesterday's session down at the 200-day moving average. And we were down at levels there not seen since the back end of December last year. So all the good work that's done in the early part of the year has now been offset with those highs at 39.30, yesterday closing out at 33.33. In a joint statement with the regulator FINMA last night, the Swiss National Bank insisted there were no indications of a direct risk of contagion for Swiss institutions due to the current turmoil in the banking market. Now, that is all very well, but natural protection of assets means that people are withdrawing money. Credit Suisse executives held talks with representatives from the Swiss National Bank and FINMA throughout yesterday afternoon after the bank's equity and bonds plunged in their value following the failure of 3 US banks last week. Now, the Financial Times first reported that Credit Suisse had requested a public statement of support. Now, as we know, Credit Suisse is the first major global bank to be given an emergency lifeline since the 2008 financial crisis. So that itself yesterday was a seminal moment, I think, in the markets. And we could well look back to this point in history as we look forward as a point at which we could well see this contagion start to spread amongst the rest of the banking sector. Now, you may say, why am I saying this? Because this is exactly what the markets don't want. But I think it's important to point out that the default swaps are rising, that we've got pressure being brought to bear on some of the bond markets, We are now, as I said, expecting the European Central Bank to go into a 50 basis point interest rate rise today. But that could well be the last that we've seen because central banks are now being sensitive to what's happening in the market. At 1:15 p.m. this afternoon, the European Central Bank will deliver that decision on interest rates. The consensus has not changed in recent days. Let's take a look at what we're expecting. The main refi rate, this is the refinancing rate, still expected to rise by 50 basis points to 3.5%. 50 bips is also on the cards for the deposit facility rate and the marginal lending rate expected respectively at 3 and 3.75%. But now this is important. Some economists believe that central banks are walking increasingly on thin ice. Christine Lagarde could decide to be more prudent in the face of a growing threat of recession. And the recession is not just the fact we're going to dip into some sort of small, shallow recession. The problem is that if we do go into this banking crisis, we must understand that this could well be a deep recession, possibly this year. And the fight in inflation, is it lost? Possibly not, because when you go into recession, people just don't buy things. And that could well in itself have a restrictive effect on inflation. But if she chooses to continue to fight inflation and maintain the pace of rate increases, she runs a risk of worsening the economic crisis. Let's take a look at what's happening with the euro-dollar trade. In yesterday's session, we saw a drop in the euro, which was money going into the US dollar as a safe haven. We got a little bit of a reversal on that at 106.17. Now, if the European Central Bank does come through with 50 basis points, then I fully expect this to continue to rise in today's session. It may not get as high as this green line here, which is the 50-period moving average at 107.29, but we could well end up seeing a continuation of what we've already seen today, and that is money going into the euro. Safe havens, well, as I said yesterday, it was a dollar trade. Let me just quickly show you what's been happening there with the dollar basket. That was the move up that we saw the dollar against a whole basket of other currencies. In today's session, a little bit of that is being unwound. The dollar Japanese yen, in yesterday's trade, the dollar rose against the yen. Today, we've now got a little sort of long-legged doji candle at 132.91, where we've seen the US dollar continue to fight it out with the Japanese yen at these levels. But the big mother of all safe havens, this spot gold market doing brisk business yesterday on the upside. A little bit of a red candle there today. And part of that response today was the move that we saw yesterday in the US dollar. But broadly speaking, we're up at levels there not seen since the 2nd of February. Now, if the move in the markets continues and we see more frailty in risk assets, we can easily see this area up here being beaten at 1,961 and 2,000, quite frankly, is the next stop-off point, which were the highs that we saw in and around this level here on the 20th of April last year, which I think should be your price target if you're long on the price of gold. I'll get back to gold in just a minute because I do want to talk about some other news in the markets because we've seen some Japanese trade data out overnight. Just want to quickly reference what's been going on there. The trade deficit narrowed to 897 billion yen in February compared to last month's 3.5 trillion. It was, however, an increase in February 22, an increase on February 22 as imports rose more than exports year on year. Let me take a look as well at machinery orders, an indicator of investment in Japan, as well as a leading indicator of manufacturing production, rising 9.5% in January compared to December 2022. Meanwhile, in Australia, the unemployment rate falling more than expected to 3.5% in February from 3.7% the previous month. Full-time employment rising by 74,900, part-time falling by 10,300, people preferring to go into full-time jobs. But with this unemployment rate falling, it just goes to show that these economies are still producing jobs at a fair lick. Over in the US, investors are waiting building permits and housing stats for February. Also, the Philly Fed numbers out a little bit later on today for March. Let's take a look at the weekly jobless claims. Economists expecting a reading there of 205,000 new claimants last week after 211,000 in the previous week. Now, I want to take a look, if I can, back at another area of the market I think it's worth looking at. Let me just bring up a chart here of sentiment, which is a gold producer. Sentiment has come out with numbers this morning. Here's the chart for sentiment. Now, sentiment is, when you look at the gold chart, you consider these gold producers are obviously going to benefit from that. We've seen some good numbers out this morning from sentiment. Revenue up 8%. $788 million for the last full year. Profit before tax up 11% to 171 million. The board has increased its final dividend. This is a company which delivers and produces gold in Egypt, and the Egyptian government takes a fair whack of the profits coming through. And there's also details of what the government, what the company has been paying to all this. But sentiment continues to increase its business. And interesting enough, going back to the gold chart, I think it's worth looking at this gold chart in the context of what we've seen there from sentiment, because spot gold is currently trading well above the levels that the sentiment is looking at making these sort of profits. That's 1918, an average realized gold price of 1794. So we've got a whole was that $200 less than where we are, or $150 odd less than where we are at the moment. So in the current period, the company is seeing profits continue to increase in the current period. And as long as the gold price goes up, then of course these companies are making an awful lot more money, which is why it's worth getting into gold companies, perhaps maybe as opposed to gold itself, which doesn't produce any dividend. But these gold companies continue to benefit from a rise in the price of gold by a levered amount. So you're getting a bigger benefit in terms of profitability coming through from these gold and silver companies as we see the price of gold and silver rise, as indeed we are seeing in the session overall in the last 18 or 24 hours. In among some of the other companies worth watching today, Deliveroo could well be worth watching at the beginning of today's session. It confirmed it will deliver positive EBITDA this year. The group says it will earn up to £50 million in core earnings this year after achieving a better than expected positive margin in the second half of 2022. When I was looking ahead to this in the look ahead yesterday, I was a bit scathing about the business model, but this is proving me wrong, and that it is able to turn a profit on this. The company nonetheless reported an EBITDA loss of $45 million. That was in line with the analysts' expectations. I'm not taking a position on this. I don't know where it's going to go at the start today, but you've only got to look at the long-term chart, whereas it saw just, I think, once it managed to meet that IPO price at 390 pence a share back in August 2021. Since then, it's been pretty much one-way travel. The stock will open at almost 90 pence, 89.9 pence this morning when trade gets underway. It'll be interesting to see just what happens there. Some of this news headline this morning is good, but on the other hand, the company still nonetheless reporting a loss at the pre-tax level. Staying on the charts, just wanted to update you as well on what's happening with Savills, the property company. Yesterday, we saw a drop of 2/3%. The company will open at 982. It believes that the first half of 2023 will be more difficult than the first half this time last year. The group posted an underlying pre-tax profit of £164 million. That was down 18% on this time last year. Revenues 2.3 billion. Savills is in this rather interesting area of the market, which is served by people who have a lot of money. They're the top end in terms of estate agencies. They have large properties on the market, but large properties are susceptible, like they are at the small end of the market, in terms of just not enough properties coming on the market. There's not enough people moving around, and those people that do have to move around, are now selling at a lower price than would otherwise have been the case. So it is a difficult market for Savills in which to operate there at the moment. Meanwhile, the good news is that we should expect Adobe to rise at the start of today's trade. Excuse me. It's expected to open with a stronger market cap after producing earnings last night, which pleased investors. The stock rising as much as 4.7% in extended trade last night after posting better than expected set of earnings for the most recent quarter. It's also raised its full year targets. The company, which makes Photoshop, amongst other big offerings, posted earnings of $3.80 per share on revenues of $4.66 billion. Adobe now expects fiscal 2023 profit per share targeted between $15.30 and $15.60 per share. 15.15 and 15.45 was the earlier expectation. So that is better than had previously been expected, which is why we saw a lift for the shares in extended trade last night. Now, they don't trade all sessions on the IG platform, but what I've done here is I've lifted up the close that we saw yesterday at $333.94, taking up 4.7%. And this is an area where we could well end up breaking the recent highs that we've seen for the company. As of the current quarter, Adobe sees second quarter revenue between $4.75 and just a little bit over $4.75 billion. largely above Wall Street expectations, which is why we saw that lift post-market in trade last night. Staying on the charts, just wanted to mop up a couple of other areas worth looking at. Brent significantly below $75 a barrel. If we see the European Central Bank go for 50 basis points, concerns are we will end up seeing demand being crushed because of recession expectations, which means that demand for oil will continue to drop. We're not too far away now at these levels from the lows that we saw back on the 20th of December 2021 at 69.30, trading at 73.70 at the moment. So we're still above the $70 level. And then there's not an awful lot stopping it then, as we see a continued pressure build potentially for oil. Yesterday, we saw the EIA come through with crude oil inventories rising by 1.6 million barrels. The stockpiles of gasoline falling, though, and also distillate stockpiles also falling, both in excess of 2 million barrels apiece. Just returning to charts, one final chart I wanted to cover, and this, for me, just typifies what's happening in the mineral space at the moment. Relatively hefty declines yesterday for the price of copper, down at levels there we haven't seen in the market since January this year. Not too far away from the lows for the year for the price of copper. If you are looking to short this market, stop goes above recent price action. Price target for me is this area down here of 8,200, which coincides with the red line, which is the 200-day moving average, and these lows that we had here back in the early part of January. That's it. The message continues to be that these markets are very difficult to predict. We are still looking for a small gain at the start of the day's trade at the beginning, at the top of the hour. Do watch out for that. But as I was saying to you earlier, I think the reality is that we've got to contend with the possibility that we could well see new lower lows established in these markets over the forthcoming days. As we work out just how deep this current mini crisis as it is at the moment develops, see whether or not the contagion spreads to other banking organizations. We're back at 10:30 with Charting Markets.